In terms of framing the debate right now, I mean, the big thing, of course, has been this tariff shock, because this has been a huge transformation to what we've been used to throughout our careers, because generally the orthodoxy has been very much what we've been taught in economics, universities and the like, is free trade is a good thing. And tariff rates have generally come down over time. And even in Trump's first term, we didn't see across-the-board tariffs. They were mostly only focused on specific industries like steel or aluminium that were considered strategic, or it was focused on specific rivals like China. The difference this time in the second term, particularly since Liberation Day, is there are tariffs on absolutely everyone. Even US allies like the UK, the EU, Japan, they have faced across-the-board tariffs as well, let alone rivals like China. And of course, on Friday, he threatened 100% tariffs over and above what have already come in place so far. So this is a huge transformation relative to anything we've seen. And even if tariffs settle a bit lower than their peak levels after Liberation Day, we still think that's likely to take the average US tariff rate up to its highest level since the 1930s. So this is a huge, huge trade shock relative to anything we've been used to in recent times. And because that came as such of a shock, financial markets had a huge reaction in response to that. So over the next couple of days after that Liberation Day announcement, the S&P 500 had its biggest fall since the COVID pandemic. And actually, over those 2 days, it had its fifth biggest decline since World War II. Fundamentally, investors were completely reassessing the outlook. Suddenly, a lot of people genuinely thought the US was about to go into recession in April. Credible people were saying that. And the fear was that the US tariffs would then lead to big retaliation and then a wider global downturn in time as well. So people were really swiftly reevaluating the outlook. But of course, as we now know, 6 months on, those fears didn't really transpire. And this chart, I think, shows it quite well, because this is looking at the number of container ships going from China to the US, so a good proxy for trade flows. And I guess the story of this chart is actually what isn't happening, because if you look at the numbers, the number of container ships going is very much in line with its levels from 23 and 24 before these widespread tariffs were imposed. Even if you look at the period in April and May, when there's a bit of a dip as the US tariff rate on China went above 100%, we didn't see a permanent downturn, mainly because in May they then reached a temporary truce whereby the tariffs came down substantially. They were lowered by 115 points on both sides. So actually, if we look at data like this, both in terms of real-time activity data, but also the jobs market in the US, things have held up pretty well. And so we're not seeing that collapse in global trade that many feared at the time of Liberation Day. And just to kind of sum this up in another sense, this is simply looking at prediction markets. Did people think there's going to be a US recession this year? And we've seen this complete turnaround from April, May time, when people genuinely thought there'd be a recession, to, as the year has gone on, the realization and the kind of relaxation, as it were, in markets that recession probably isn't going to happen. And that has led to a huge boost of confidence, not just in the US, but of course in the global economy more broadly. There's been hope, particularly since the summer, as Trump reached trade deals with a lot of countries, that we are potentially now entering a more certain period on the tariffs. That was somewhat undermined, of course, this Friday just gone when he made the China announcement. But the sense is, perhaps we're going back into a bit of a first-term mode where China is the one target, and actually with these US allies like the EU, Japan, the UK, their trade relationship is now settled. The focus is mainly on the US-China trade war now. But for all that resilience, the one thing that is concerning, and this impacts emerging markets too, is what's happening with inflation. Because, of course, tariffs by their very design raise the price of foreign imported goods, basically because they want to make those more expensive and give an advantage to domestic goods. And we can see from leading indicators of US inflation that inflation is very likely to tick up over the coming months. And we know these tariffs are hitting month after month. Some people have described tariffs as a one-time price shock, but I disagree. And the reason is that they are being implemented sequentially. So we had initial tariffs on Canada and Mexico. We then have a global 10% baseline. He then imposes a bunch of sectoral tariffs on steel, aluminium. We then have another bunch of trade deals with higher tariffs. We've then had this latest threat on China, on top of all the stuff on furniture, on trucks and the like. So, month after month, tariffs are still coming into effect, and that is going to keep raising the price level as we move forward into 2026. And where that could be a big risk, I think, and certainly the biggest thing I'm worried about realistically in the next 6 months, is does that higher inflation mean that the Federal Reserve has to pivot back to rate hikes? Because we know when the Fed are hiking rates, that can have pretty negative effects for emerging markets too. So that's something I've very much got my eye on, because the growth figures have actually remained remarkably strong in the US. In the most recent quarter, they were growing at almost 4%. GDP trackers suggest that will continue into Q3, likely to be a bit of a blip due to the government shutdown this quarter. The fundamentals remain very strong, particularly because the US has AI now powering its economy. There's evidence indeed that without the AI data center tech boom, that the US economy might be shrinking right now. But nevertheless, it's doing incredibly well because of that. So, that prospect of a re-acceleration in higher inflation, that could be a big issue as we look to next year. And we know investors are fearful about this. One really striking trend, particularly in the last couple of months, has been the huge surge in gold prices. Now, this is just one proxy, but of course, gold is an asset that investors tend to move into in times of fear, particularly when they're worried about inflation, about an erosion of the real value of their money. And obviously, we've got a lot of policy uncertainty right now, from tariffs. We've got a tax on central bank independence in several countries. So it's no surprise that investors are looking out for assets like gold that would maintain their real value in times of stress. And actually, the big milestone that was achieved last month was that if you adjust for inflation, gold prices actually exceeded their previous peak set back in January 1980, when inflation was raging in double digits very strongly after the 1970s. So the fact that gold prices are at record highs, even if you adjust for inflation, is a really striking feature of the landscape right now. So yeah, on the one hand, you've got this huge resilience, financial markets on the whole holding up very well, but there are also those signs of fear at the same time. So there's this kind of paradoxical quality to the outlook right now that is very hard to make sense of in some ways. What I think is going on is that markets are acting to some extent as a bit of a brake on policymakers. That's how you reconcile it. So long as the growth data is resilient, every time there's a sell-off, we see policymakers row back. So actually, that's what happened in April when you had that big turmoil. The turmoil itself scared policymakers. They don't want to see negative headlines. They don't want to become unpopular. And that was what caused the big 90-day extension that then calmed that turmoil and then led to the tariff reduction between the US and China. So markets are acting as a bit of a brake on policymakers right now. And as long as the turmoil, such as it is policy-induced, it's quite easy for them to reverse course.